I guess this is the point where I need to put all of the pieces of this course together. Emerging markets corporate finance is obviously not the standard corporate finance. And a lot of this course has to do with the extra things that we have to look at, the things that are different, the things that distinguish emerging markets from other markets. Yeah, let's face it, emerging markets is just some label designated by the World Bank, depending upon what GDP per capita you actually have. Yeah, that doesn't really mean anything. It's just a label depending upon your per capita production. What we've tried to understand is, like, what are the characteristics of these countries that make them different, that make it such that we have to be extremely careful in the way that we implement some of the tools of corporate finance. Indeed, it is a potentially very serious mistake to take some model that's calibrated to developed markets and apply it to emerging markets. And I can think of two good examples of this. The first one would be the capital asset pricing model. Capital asset pricing model makes a lot of assumptions. For example, you can derive the model assuming that asset returns are normally distributed. Well, that's just not the case in emerging markets. They're nowhere near normally distributed. So a CAPM that only looks at expected return and contribution to variance is not that useful. Indeed, it might not even be possible to invest in some of these markets on a portfolio basis. The market could be segmented, so the assumptions of the CAPM fail. Another interesting application is credit scoring models. These models are calibrated often with US data. Now, we just can't apply this model to an emerging market. There's many other factors we actually have to look at. So you have to be very careful. We've developed a set of corporate finance tools in taking the basic courses at Duke. But we need to be very careful that we kind of don't fall into the trap of naively implementing these models that are calibrated on particular situations that are so much different than our situation. Indeed, this is maybe the main criticism of the case approach. And actually, this course is about cases. And I guess we need to be aware of this main criticism. That often students that are just instructed in the case method tend to look at situations when they graduate or working in business. They tend to frame the situations that they're involved in terms of the cases that they've dealt with. And this is a fairly limiting sort of way to look at a situation, where somebody who's trained in the theory first will tend to think about, well, what does the theory suggest that we do in this actual case? So emerging markets, I think, are a good example. We might be trained in terms of models and cases that we study in developed markets and try to apply kind of that way of thinking to emerging markets cases. And we're going to fail if we do that. So what we've tried to do in this course is to distinguish what's different about emerging markets. And indeed, maybe what's the same. Emerging markets and developed markets. So one thing that we did, and perhaps most of the time in the course was spent on trying to think about country risk and how to incorporate that into a project evaluation. And I think we came to an understanding of this. And the basic understanding is that we would use an industry-based world capital asset pricing model. And this would be calibrated to worldwide industries, and actually I'm in a project right now to post industry hurdle rates on a worldwide basis on my website. And this would be the base expected rate of return. And then we actually explored the International Cost of Capital Risk Calculator, the ICCRC. And what this does, it gives a hurdle rate that's appropriate for the average equity investment in a country. Now, these rates of return are much higher than the industry hurdle rates. We talked about a methodology to actually implement this. And the first thing that we need to do is to recognize that the particular project that we're looking at could have much different risk characteristics than the average investment in a country. So if this is an oil field in some emerging market, all of those dollars in revenue are going to be coming in US dollars, and that's a major mitigation of exchange risk. We have to look at the particular situation and adjust the countrywide cost of capital either downward or upward. And then what I suggested is that you take the difference between the base hurdle rate formed off industries and the country risk, which is formed from the ICCRC, and then use that to calibrate your cash flow assumptions. So you could either increase the discount rate or reduce the cash flows to reflect the country risk. And actually, I prefer to reduce the cash flows because it gives you more flexibility in terms of your Monte Carlo analysis, crystal ball, or whatever sort of simulation package that you use. So instead of simulating both the numerator and denominator, let's just simulate the numerator. Well, we come to some understanding of this in terms of how to get the hurdle rate. But the other thing that is maybe different and similar to developed markets project evaluation is the role of real options. And we spent some time trying to go through the different types of real options and try to apply these to emerging markets. And it turns out that the prevalence of real options is much more acute in emerging markets. That this is something that we just cannot ignore. Sometimes it's ignored in project evaluation in developed markets, and it shouldn't be ignored. But to ignore it in emerging markets is a serious mistake. So the other thing that we talked about was, in project evaluation, the importance of looking at different scenarios in terms of the Monte Carlo analysis and the possibility that discount rates that we use change through time. We looked at this in a number of different scenarios. The first scenario was that if the project's financed by debt, that it's likely that the debt-to-equity ratio will be reduced as the project goes on in time. That needs to be reflected in a decreasing discount rate. The other thing that we looked at was this idea of time diversification. That the ICCRC produces a very large hurdle rate for a one-year investment. But if you implement it on 2 to 5 year investments, the rate is often reduced. And this reflects the idea that equity returns are very volatile if they're sampled at 1 year intervals. But for a buy and hold of 5 years, it's a different story. You know, even if you take an extreme example, like what happened to Korea beginning in mid-1997, where a huge amount of the value of that market was erased in the Asian crisis. But a couple of years later, it's all back. So a 1 year holding period looks disastrous. But a 3 or 4 year holding period, a lot of that volatility is smoothed away. There's a big negative return, but then there's a big positive return. So we need to incorporate kind of a term structure of discount rates into our project evaluation. And kind of the last thing that we did in the course was a way to screen companies that often we're interested in purchasing or acquiring companies in emerging markets. And what a task. There's 10,000 firms. Which one do we choose? How can we even approach that? There's one thing, just to figure out what the country is. Say we choose India. Well, we've got 7,000 securities that are traded there, 7,000 firms that have publicly traded equity. And then there's thousands other firms that are private. How do we approach this problem of identifying targets? Well, one way to do it is to talk to somebody local. And I'd suggest that's the last thing you want to do. Because if the locals know what the story is, if there's a good deal, it's likely it's not going to last for very long. And what I suggested is kind of the building of some quantitative models, very similar to the models that we use in global investment, that screen firms into winners and losers. And certain characteristics are used. And these characteristics depend upon the certain market that we look at. And they identify winners and losers. And for us, it's very useful to kind of screen all of the firms in that particular emerging market and to come up with a short list. And that's all this quantitative tool actually does. Develops a short list. Then we can dig deeper. Now, the short list that's developed is usually a short list of publicly traded firms. But the way the screening actually works, we look to see what factors are important for individual firms. Well, a lot of these factors are available even for private firms. So what it does is it gives us a way to evaluate what's important and what's not important in a particular market for both public and private firms. So it gives us a model, it gives us some way to filter a lot of information and potentially pursue a successful M&A style strategy in emerging markets. Well, I guess my view of the future of emerging markets, I really do believe that they are the engine of growth in the world economy. That these are like small firms in the growth stage. And there's plenty of opportunities here. Indeed, the US was an emerging market and now is a developed market. All of the developed markets were emerging markets at one point. And we've got maybe 70 some odd markets with equity, but hundreds of countries. There's going to be new emerging markets, and the markets that are classified as emerging right now will grow into developed markets. There is a huge investment potential for both portfolio and direct investment. A simple examination of growth opportunities, the historical track record is very impressive. You want real growth, you invest in emerging markets. Now, of course, in finance, there's a trade-off. If you want the high expected return, there's going to be some risk. And a lot of this course is focused on trying to identify and to measure the risk. Is it a pure trade-off of risk and expected return? Is there no possibility of making expected return over and above what you would expect given the risk? Well, I actually believe that there's plenty of opportunities of making returns over and above the risk. There's plenty of opportunities because these are young markets. They are not as informationally efficient as developed markets. There are plenty of opportunities to create value. And indeed, maybe another way to view this course is kind of a cookbook for creating value for shareholders when we focus on emerging markets.